Good afternoon, ladies and gentlemen. Welcome to Business Today Television and to our special show, Market Masters, where we get you to meet people with phenomenal talent, professionals with a very deep understanding of equity markets, especially our domestic markets. And over the last 2, 3, 4 decades, they've made supernormal money for their clients as also for the organizations that they work for. Our guest today is a very quiet gentleman. His name is Nischal Maheshwari. Mr. Maheshwari is the Chief Executive Officer of Centrum Institutional Equities, where he joined from 2018 onwards. And prior to Centrum, for 16 years, he was the Head of Institutional Equities at Edelweiss Securities Limited. Mr. Maheshwari, good afternoon and a very warm welcome to you on Market Masters. We are delighted to host you, and we hope that the next 40-45 minutes will have extremely wonderful conversation on where as a country we stand and where are we headed in terms of how the market is placed. To you, the first question is, we've seen a nice correction in the market as far as the main index is concerned, 20,200 levels to about 18,800. How do you see this overall macro geopolitical mess that the world is in, and how do you see that impacting domestic equities over the next 6 months?
Afternoon, Shail. Thanks for hosting me. It's a pleasure being here. Yes, I think markets have corrected, and the correction has been more than what most of the people were expecting. But I think it was more or less coming because if you look at the situation across the world, you have an uncertain macro as far as the US is concerned. And the US macros, as you are aware, basically drives the whole world. And there you have a yield, 10-year yield going up at 5%. Inflation, though it is coming down, but unemployment number doesn't seem to be moving. And we have a quarterly number of GDP, which is a 5-year high. So I think these are kind of dichotomous situation as far as US is concerned. Similarly, we have some issues across the world. Whether it is the Ukraine war or whether it is the recent one where Israel and Hamas are concerned. So I think there is a lot of disturbances across the world, and that's why you're seeing this kind of uncertainty happening. You are seeing that the FIs want to pull out money given that there is a 5% yield on a 10-year in the US, and US is the safe haven, so they want to move their money back to the US. And we are seeing continuous selling happening in the last 2 months. Domestically, though I think domestic has been on a good wicket for the last 5 or 6 months, but now seems to be, I think, giving some way. And I think this correction is also healthy, given there was quite a bit of froth which had built up on the market. So overall, I think this sideways corrective market will continue for some more time.
Okay. Mr. Maheshwari, since you cater to the institutional business and have very deep relationships with foreign institutions as well as domestic players over the last 2.5, 3 decades. How do you see the mood within foreign players? It's understandable if the US 10-year is at a 16-year high, then money will move back to Wall Street. But are these people willing sellers, or are they reluctantly going away from Indian markets? And at the same time, are domestic institutions lapping up this liquidity with both hands, or are they reluctant buyers?
So I think as far as FIs are concerned, I would say basically they have waited for a good period of time, and they are sitting on a good amount of profits in the domestic market. So it made a lot of sense for them to pull out money and go back to the US at the moment. But having said that, if Fed decides that maybe this week when Fed meets, this is the last hike or the hikes are done for, then you might see some amount of reversal happening out there. So people might once again come back, and if India also corrects some bit, so they might reverse and start coming back to the country. As far as I think the domestics are concerned, I think they are loving it because they are all getting so much money basically from the domestic market. I think 13, 14, 15,000 crore kind of a number every month. And the SIP still seem to be very, very sticky. So I think they are getting a chance to build up their portfolio, which they are doing with both the hands.
Okay. Good afternoon to you, Mr. Maheshwari. Sakshi this side. We are in the midst of the festive season, but somehow this festive spirit is not translating into the street. The move that we are seeing, mixed October so far. What do you think is really capping the upside for the markets? Is it more to do with the geopolitical concerns, the macro concerns, or is it more to do with the valuations for India?
Afternoon, Sakshi. I think it's more to do with the geopolitical situation across the world. You have oil basically, which is at $90, keeps on threatening to go towards 100, and a 5-year yield, a 10-year yield, the US at 5%. So I think that is what is driving this market actually. So I think there is macro uncertainty. China is also not growing at the same pace. So that is the situation basically because India also, if you as you know, basically almost 20%, 25% of its India's GDP is exports. And if that one leg starts becoming a bit wobbly, I think you are going to see some impact of growth happening on India also. So that's why I think people are a bit concerned. Wherever there has been a lot of froth, I think profits are being taken both by the domestic as well as international investors. And I think this is a good, happy correction which is happening at the moment.
Okay. Nishalji, if you look at the granularity of the Indian market in terms of improvement that has happened over the last 2 or 3 years, if you maybe look ahead a year from now, 2 years from now, how bullish do you feel, and where do you see a lot of money coming into in terms of sectors, in terms of macro calls that equity strategists such as you take?
So if you really look at it, Shail, I think the long-term equities have delivered a good return of around, I think, 13, 14% kind of a number. Now, every year it may not be so, but when you look at a cumulative period of 5 years or 10 years together, you will always find this equities have been delivering that kind of a number. So on a long-term basis, am I bullish on equities? And should suggest people to be fully invested? I think yes. Every correction should be looked at basically where you should be trying to find stocks which you like, which you have studied, which you have researched yourself basically. I think those are the stocks you should keep on accumulating in this kind of a market. And I'm very sure basically that a 13, 14% kind of a return on a longer time horizon will definitely happen as far as equities is concerned. The sectors at the moment, what I like are mostly domestics, domestic consumption. That is what we have been recommending, given that I told you earlier also that that exports seem to be a bit sluggish, given that we are seeing concerns as far as international growth is concerned. And that's why we have been recommending that you should be focusing on the domestic consumption.
Okay. Mr. Maheshwari, what is your take on the results that have come out so far? Any company or any industry that has given you some kind of a surprise? What is the general sense that you are also picking up from the management commentary so far?
I think so far so good. Earnings was expected to be strong. I think the earnings have come across as strong. I think the banks have really shown stellar performance. There has been no concern as far as credit is concerned, credit costs are concerned. They have been now saying more or less their costs are peaked out as far as their NIMs are concerned. So I think bank seems to be doing a very good job. A bit disappointed with IT because we were thinking that IT would recover at this point in time, but I think maybe another quarter or two basically before IT starts coming back. FMCG, another sector basically is very clearly saying that the recovery which people were expecting on the rural side has not come on as yet, and it's delayed. So what I see, especially on the domestic consumption, that the lower end of the domestic consumption is still struggling, but the middle and the high end of consumption is definitely doing very well.
Okay. Mr. Maheshwari, while we are discussing earnings, there is this very bright and an extremely sweet spot in which mid-cap IT finds itself to be. Look at any company which has a turnover of, say, sub 5,000 crores in the mid-cap IT space. Market capitalizations have zoomed. Stocks rise 20, 40, 50% a month. What exactly is happening? And this is against the backdrop when large cap IT is not performing. I think in both our experience over the last 30 years, it's for the first time that top 3 or 4 IT companies have actually shown more attrition than addition.
So, what you're asking, Michelle, is two different things. One is why the mid caps are doing well and not the large caps, and then the attrition is a different question altogether. What I very clearly see here is basically that the smaller stocks still continue to show growth. So you look at the few results which have come out, all have still shown growth, unlike most of the large ones, basically where the growth is anemic. Rather, actually, there has been some degrowths happening in the current quarter. If you really look at it for Tech Mahindra, TCS, I think all of them have shown anemic growth, basically. But if you look at some of the small caps, I think whether it was, I think a few of them got delivered, Birla Global or Zensar or Happiest Mind, I think all of them have shown, I think, 3-4% on a Q1Q growth as yet. So that's why I think the money is moving towards mid caps. And as you know, mid cap as a group has done very well. So that's why you continue to see that the mid caps are being favored over the large caps. And so that is what I see as far as small cap versus or mid caps versus large caps are concerned in IT sector. And I think this trend will continue for another couple of quarters because, as you know, the large caps are, I think they are all sizes of $5 billion plus. So they are elephants now. I think to move them, basically, you really require the US economy to do very well and for a consistent period of time. So I think we have to wait for a couple of quarters more, basically, before the large cap IT start to well. Now, as far as attrition is concerned, in the large caps to mid caps, basically, I think we are seeing this is an outfall, basically, that there is hardly any growth. And they don't want to build up benches. They have, wherever they are given letters also, they are delaying the taking in of people. So I think that is an outcome of that, basically. As soon as they start seeing visibility of growth, I think they will be back onto the hiring side.
Okay. Mr. Maheshwari, at this point in time, let's start off by taking the viewer questions as well with you. The first question that's come to us is from Mumbai, from Dharmesh Shukla, and he wants to know from you, would you recommend to stay away from mid and the small caps given the outperformance till date and the valuations as well?
So I don't think so. Basically, as a group, one should be staying away from mid and small caps. I think it is a very stock specific thing. Mid caps and small caps are not particularly until it belongs to one particular industry where you are fearing a problem. I think individual stocks, there are a lot of good stocks out there still which are still available cheap. I think you need to do your own work basically and identify them.
Mr. Maheshwari, when you talk about doing a lot of self-oriented research in terms of stock picking, what are the 4 or 5 parameters or filters that Centrum is using to identify relative underperformers in this market? Because everything has doubled or tripled over the last 6 odd months or so, and tons of money is chasing very, very few stocks, most of them centered around the PSU basket. So how are you trying to convince institutional investors to pour in or continue pouring in money in specific sectors?
Well, I think basically if you really look at it, the banking sector itself, which is the largest, there the performances have been very good basically, and there are enough stocks in the banking sector which are still available at relatively cheap valuations. I think HDFC Bank, for example, I think outstanding quality of management, outstanding track record. The stock is not performed for the last 1.5, 2 years for the reason basically which is nothing to do with the bank. It was a merger basically which was supposed to happen and everybody knew about it. What is the bank suffering at the moment? I think they have given a stellar performance again this quarter. The only issue remains to be is basically that it's been overowned, and that's why you're seeing and getting this opportunity to buy into it. Similarly, you'll find several mid-cap and small-cap banks out there. I think BFSI space itself is giving you a lot of opportunity, and there are several other spaces which we can discuss.
Okay. Another viewer question let's take at this point, Mr. Maheshwari, with you. From Noida, Surinder Suri wants to know from you how to avoid making losses in the stock market. Something that a lot of investors would be interested in knowing, sir.
So I think somebody has to understand, or everybody has to understand, stock markets is all about risk. So if you do not have that appetite, basically, I think you should totally avoid it and just go through the mutual fund route, which is a much better route. And I always recommend to all retail investors that the best way to do investment is basically through a mutual fund route, rather than actually trying to do themselves. But having said that, I think losses are part and parcel of this thing. If you want to be a part of the stock markets, you have to learn to take losses.
This is Sakshi, 25, 30 years of hardcore experience speaking as far as dealing with markets is concerned. Mr. Maheshwari, when you speak to the corporate titans in Mumbai, in India, what is the granular feeling that you are getting in terms of capacity expansion? We are going through probably the second cycle of capex expansion over the last 25 years or so, where bank credit is growing, newer factories are being set up, a lot of overseas money is coming as FDI into the economy. What is the understanding, the broad understanding that you have when you speak to managements, when you speak about their growth plans? What are they thinking?
I think after a long period of time, I think the industrial houses, basically the corporates, are feeling confident once again to go out and start investing and creating more capacities. I think they are more confident about the outlook for the next 3-5 years, what kind of growth they are looking at. And also, I think one should also understand that the balance sheets are much more stronger than it would have been 5 years back. India corporate world has been deleveraging for 4 or 5 years. Now it is ready. There are plans. The government policies are very favorable. So I think all these things are adding up basically for the industrial captains to feel confident about going out and creating capacities. The other thing which is really helping is the China Plus One policy. And their world order seems to be changing. Everybody wants across the world to have another source. And I think that India is becoming a more natural choice out there. So I think that's another very good factor basically which is driving this capex.
Okay. In terms of how the 5-year positioning looks for Indian markets, how do you see the Nifty in the short term, and where would you peg it, say, in the medium term, 3 years from now?
Still very difficult for me. I do not really look at the market from that point of view, basically. Nifty may go down, may go up, but I am very, very bottoms up person basically, and look at the stocks. If you are buying stocks basically with good management, strong balance sheet, strong cash flows, I think basically whether Nifty goes up or down, your stock will continue to do well. And now obviously if the whole market collapses, obviously your stocks will also go down. But I think what you should be focused on is basically that your stocks are going down lesser than the market. And that's what I think is right way to look at it. So yes, definitely for the next 3-5 years, Nifty will definitely be much higher from here. But I have no idea about.
Mr. Maheshwari, let me press you on this. When you look at corporate balance sheets, when you look at growth forecasts of banks such as HDFC, ICICI, Kotak, and you try to do stock picking in the blue chip universe, where exactly are you finding value in terms of sectors? And if you could share one or two top names where there is deep value to be had over the next 3-5 years, irrespective whether stock is at a record high or not.
Banks is one sector we see with deep value out there. I'm saying the prime case is HDFC Bank. Again, IT, I find it's deep value again. And there are so many of the large cap ITs are all value, deep value basically. I'm saying these are all large companies, very strong cash flows, exceptional management, strong track records. I think what else you want? I'm saying they are generating more cash than basically they have historically been doing. So I'm saying these are all very good places to be in. What I think the market doesn't understand that you need to be patient and you have to see in a cycle of 3 to 5 years rather than actually trying to say every 3 months basically the market has to perform. That's not what stock markets are.
Okay. Let's take another viewer question also with you, sir. What, according to you, are the biggest risks for the markets right now? This is a question that's been posed to you by Sumitra Sen of New Delhi. The biggest risks that markets face right now.
I think the biggest risk remains to be the global macros, how the US economy is going to pan out, and whether US is going to go in for a hard landing, because I think maybe 3 months back, basically, we were all of the opinion saying that now it's going to be a soft landing. But with this kind of high GDP growth, which we had last quarter, and this interest rates are going to be higher for longer. If that happens, basically, it's going to kill growth. And I, at least for the moment, see a situation of stagflation happening in US. That is what my worry remains to be. And I think the corporates out in the US are pretty cautious about this. So I think growth is going to be a challenge as far as the global markets are concerned. So my worry remains to be that.
Okay. Another question let me take with you, sir. From Indore, Shujit Natyal wants to ask you, what is your sense of the new age tech sector right now, and any particular stocks from this basket? We've talked about the traditional banks, IT a lot, but what about the new age tech stocks like Zomato, Policy Bazaar, maybe FinTech, Nykaa, for example, Car Trade Tech, Delivery, all of these stocks? Do you track them actively now?
Yeah, we do track them basically. And I think after their corrections actually, and they have matured over a period of time, I think what the market missed was basically most of these stocks were in a hyper growth phase basically because they were being fueled by the private equity money. But when they came into the stock markets, basically, obviously the whole way of looking at those corporates was a different from the stock market people, and that's why these stocks corrected much more. But I think the good thing remains to be that these guys have learned very quickly. You look at it, Zomato is talking about, I think most likely they are going to be EBITDA positive this quarter. We have seen Paytm change its business model and now becoming, I'm saying by 24 end, I think this quarter he's talking about being profitable. We have got Policy Bazaar, which seems to be on a good wicket. So I'm saying there are some of these spaces basically where these guys have learned very fast, turned around, and they have now giving the same kind of statistics basically which the stock market people like. So I think some of these companies are in a very good shape and they've created a monopoly, duopoly kind of situation, and they are in a very strong place. So I think some of these stocks are really good.
Nishalji, when you analyze the small cap and the large cap space, the reason why I ask you this is that the money flow, especially from the retail investor, is intensely focused in this space, even via equity funds. What has changed in this space over the last 2 years, which is attracting so much of interest, both from the retail side as also from the ultra HNI side?
So I think to begin with, 2 years back, obviously they were undervalued. The growth came back basically, and historically we have seen that in a good scenario when the economy is doing well, the last guy in the line basically starts getting the benefit of the upturn in the economy. And that's what happened basically. So mid caps, mid caps and small caps starting getting the benefit basically for a Goldilocks scenario of the economy. And accordingly, they've done very well, and market has rewarded them. But then it goes on to a virtuous cycle. So the more the performance, the more money comes into the mutual funds, and the more money goes into the same kind of stocks. Now, the one thing basically which has become a bit negative here is basically that there is a limited number of stocks basically where the mutual fund can invest, given the sizes of these mutual funds. So every incremental money is now going and buying the same stocks, and that is in turn inflating the whole thing. So that is what the problem remains to be at the moment. So somewhere I think that virtuous cycle has to peak out, and I think has already peaked out, and I think some amount of profit taking is happening.
Okay. And since you look at the overall macro trends in the economy, which you sort of import on the markets game plan, where are bubbles building within the economy, and where are these bubbles getting bigger and bigger in size as far as markets are concerned?
I think it's too early to say that we are building bubbles in the market. I don't see any reason for being so speculative, saying bubbles, because I think economy or the market, if you really look at it, basically why the markets, people like us are feeling comfortable even at 18,800, 19,000 is a reason basically that for last 5 years the earnings was growing basically and the market didn't go anywhere. And then now, basically, for the next 2 years also, we are still looking at an earnings growth of 15% plus.
Right.
So this is what is supporting the market. So I do not see, barring few spaces here and there, basically where there might be overexcitement, I do not see any big bubbles getting created.
ओके निश्चल जी, बहुत सारी डिमांड आ रही है कि हम आपसे कुछ सवाल हिंदी में भी पूछें, तो मैं आपसे जानना चाहती हूँ इसी सवाल के एक्सटेंशन में बहुत सारे पॉकेट्स में हमने बहुत ज़बरदस्त शॉर्ट टाइम में तेज़ी देखी है। डिफेंस स्पेस को अगर हम देख लें, रेलवे स्पेस को देख लें, पीएसयू बैंक्स को देख लें, यहाँ पर जिस तरीके की तेज़ी आई है, क्या आपको लगता है कि ये तेज़ी आगे भी जायज़ रहेगी और यहाँ पर अभी भी निवेश के मौके हैं इन्वेस्टर्स के लिए, या फिर यहाँ पर कुछ अब रिस्क आ रहा है?
I'm not very good at speaking in Hindi, but I will try basically. Though I am a North Indian. तो ये तीनों स्पेसिस में ब्लैंकेट कहना कि ये तीनों स्पेसिस में तेजी बनी रहेगी, क्योंकि आई थिंक वो ब्लैंकेट अंडर वैल्यूएशन खत्म हो गया तीनों स्पेसिस में, कि जहाँ पे सारे बैंक्स वर अवेलेबल एट 0.2 0.3 टाइम्स ऑल द PSU बैंक्स, or the defense companies were available at very cheap valuation. तो वो जो blanket under valuation था वो खत्म हो गया. Now it has to be very very stock specific. आप जहां भी पोजीशन लेना चाहते हैं, मैंने वही बोला, आप खुद स्टडी करें, उसे देखें, कंपैरेटिव मार्केट में देखें और उसके हिसाब से ही इन्वेस्ट करें.
Nishal ji, the other thing that has changed dramatically, I don't know for the better or for worse, is this huge influx of derivative traders and option themes as well as futures in our daily lives. As an institutional player, how do you see it against the backdrop of that SEBI report where 95 to 99% of people who enter this space actually end up losing? So are institutions making all that money, or where is it going?
So you must be aware, institutions are not allowed to do anything in the on the derivative side. Neither mutual funds, neither insurance companies, they are not allowed to do anything. And I think the FIs must be doing it basically, but FIs are also taking a sort of a contra position, or basically positions where they want to build up large positions basically, but cannot do it because of lower liquidity in that particular stock. So I don't think so that the institutions are on the other side of the retail. It is the retail versus retail or retail versus HNI. I am not very clear basically because I do not track that space much.
Okay. One question which is perhaps related to this has come from one of our viewers from Chandigarh. Rupam Gautam has written to you. He wants to know what methods do you employ to reduce risk in your stock investments then?
I don't do anything basically. I am a long-term investor. I am very patient investor. I just buy and hold. The only thing I do is basically track them very closely. I listen to all the calls, given that I have access to it. And I keep on getting access to meeting managements. That is the only thing. Reading balance sheets, that's the only thing I do. I do not do anything else for reducing risk. I'm a long-term investor, so I'm saying over a period of time, basically the risk automatically gets reduced.
Okay. What would be the best balance sheet that you've read for the past financial year, Mr. Maheshwari?
I think you can read any of the FMCG balance sheets. I think they are amazing, actually. You can read any of the, I think, IT balance sheets. They are very, very amazing. We have a product basically where we analyze last 10-year cash flows, and we've been doing this product for last 3 years now for all the coverage companies which we do. And that's been very well accepted. I think if you ever get a chance, I'll send a copy across to you. Do have a look at it. So we have analyzed the 10-year cash flows of all the companies which are under our coverage. And that really shows you, it's been a big eye opener for people like us also, who have been tracking this market for the last 25, 30 years.
I'll be very, very thankful if you can send that copy to us. It'll be an amazing learning experience for both of us too. And of course, it'll offer us deep insights into how money is being utilized and spent within the top 250 space in the corporate sector. Mr. Maheshwari, we've talked about global macro, we've talked about how Indian markets have improved dramatically over time. Within the Indian economy, what is the most worrisome factor according to you?
So I think the one worrying factor to me is basically the rural recovery. That doesn't seem to be happening for a long period of time now. I think 1.5 years. If you remember, basically the last 10, 15 years, strong growth has come back on the back of very strong rural growth. Because 70% of Indians live in the rural side. So I think that's a very large economy. That doesn't seem to be reviving at the clip which we all expected. And now we are hoping that I think this festival season should bring in a strong recovery. But if I would be worried about one thing is that.
Okay. At this point, let me take another question. Interesting question there from Mumbai. Pooja Vittal wants to know, how do you see general elections then impacting the Nifty over the next few months?
Historically, no elections ever have impacted the market. If you go back into history, we have looked at it. We have studied it for, I'm saying, for last 25, 30 years. No elections ever impacted. Basically, it's a very small impact of that particular week when the elections are going to get decided and declared. Yes, if there is a change in government, basically, yes, then definitely market adjusts itself, given that there might be some changes in policies. But if it is a continuation, I don't see any change happening.
And I'm very sure that all those people who've put in their hard-earned money via systematic investment plans into India, into the market, as also the ultra HNIs are hoping for continuity when it comes to the general election, May 2024. True. But that's something to be looked at. I have seen two Nifty circuits, one down and one up over the last 15 years. Yeah. But as Nischalji says, it just gets harmonized out. It's a one-day kind of an event, and that's how it happens. The other dramatic change in the economy, Nischalji, that has happened is in the auto sector. We are seeing large-scale capacity expansions being announced by the likes of Maruti in terms of passenger vehicles, and other commercial vehicle segments are also not far behind. Is this space that interests you given the backdrop of rising consumerism in India?
Definitely, I think it was some time. Basically, autos have not done well. Basically, it was high time that autos started doing well. Still, I think two-wheelers is not the not seeing the same kind of growth. That's what I was trying to highlight when I was saying that in the rural side, we are still worried. So we are still not seeing the entry-level motorcycles doing as well. It's the higher-end motorcycles which are doing well. PVs have been done well basically last year and this year also. I think CVs did well last year, but I think it's a bit sluggish at the moment. But I believe basically economy continues to do well. I think CV cycle should also pick up pretty well. Tractors is down. I think last 2 quarters it has been down, and I still continues to be worrying. So these are the ways basically which we look at auto. We definitely like autos at this moment and are overweight in our portfolio.
Okay, let me ask one more question from our viewers. This is from New Delhi. Karishma wants to know from you, sir, old economy or sunrise sectors? Where are you placing higher bets at this point in time?
So I'm saying, I told you, I'm a very stock focused person basically. So it doesn't matter to us. Wherever we find value, wherever we find, and I told you basically, in the new economy, I like quite a bit of those stocks basically. If there is a niche which is somebody is like a Zomato has created, I'm saying there are only two companies now to set up another company like Zomato. I'm saying even Zomato or Swiggy, both of them spent close to $5 billion for coming to this position. So I'm saying it's very difficult to dislodge them. So you have to find the right business and you have to ride out the wave along with them.
Sure.
Saying it can be a, I'm saying multi-bagger from you.
But are you also looking at, say, sectors like green energy, solar, EVs, artificial intelligence? Are you looking at these new themes incrementally, positively now?
We are looking at new themes, but I'm saying there's very little to play there. So these are all good themes, but very little stocks to play. So difficult to play these themes at the moment.
Mr. Maheshwari, when you mentioned about being overweight in the auto sector, within your model portfolio, number one, how many stocks are there? Two, where are you overweight in, and where are you at the moment looking to be underweight?
So model portfolio, basically, we have around 30 to 35 stocks. And we typically are, as I was telling you, I was overweight on consumption. So we are overweight on banking, FMCG. We are overweight on auto. We are overweight on cement and construction. And we are underweight on, or equivalent weight on IT, equivalent weight on pharma, and the commodities, which is cement, which is metals, and underweight on chemicals. So that's the way the portfolio is built.
Okay. And of the 35 stocks that are there in the model portfolio, how many of them are large caps, and what is the percentage of mid and small caps?
Given this model portfolio tracks Nifty, the majority of these stocks are Nifty, actually.
Fair point. And how much of cash are you sitting in positionally?
We do not look at cash at all because I believe basically that the money has come to be invested into equity, so no cash calls.
Okay. The meltdown in the chemical space, Mr. Maheshwari, has been much storied, and of course you are also underweight in that sector. Do you see this chemical cycle turning fairly soon?
At least the current quarter result doesn't say so. I think yesterday only SRF results came, and they have said that, yeah, second half is going to be better. But we want to see that basically to happen. I think still we track the international markets also, and nowhere they are calling it out saying that the demand is recovering. Or so one thing has happened. The stocks in trade basically, or the inventories, they have definitely come down across the world. But we are not seeing basically that the growth is back basically where they are talking about increasing production or anything like that. So whether it is Europe, US, And China is being playing a spoil sport out there, basically, because they have now come back in full production and they are dumping across the world.
Since we are at the fag end of the show, let's again turn our focus back to global macro. Nishalji, there is this huge spike in the price of gold, and that's macro-led because of safe haven buying or whatever is happening geopolitically. Is this a turn for the better as far as gold as a commodity is concerned, or is this a blip that you see, all against the backdrop of a US recession, possibly 10-year bond yields at 5%, and the fact that we have a global risk of trade in equities mainly because of geopolitical problems?
So I'm no expert on multi-asset classes, basically, and do not track gold much. But I've historically seen that gold is a safe haven, basically, as you are pointing it out. And every time we see this risk of trade happens, basically, you will see gold prices doing well. So all precious metals do well, basically, during this point of time. I think similar thing is happening at the moment, basically. But will it continue to do well or not? I think totally depends upon how the US 5-year yields or 10-year yields behave. And if you look at it that the interest rates are going to be higher for longer, I think that way I think gold prices should be higher for longer also.
Right.
Okay, Mr. Maheshwari, thank you so much for the quality time that you spent with us, sharing your deep insights into various parts of the market, as also market cycles that we seem to be undergoing. It was such a pleasure to listen to you, and we hope that you'll soon be a regular guest on Business Today. Thank you so much for your time, sir.
Thank you.
Thank you, sir.
That, ladies and gentlemen, was Nischal Maheshwari. He's the Chief Executive Officer for Institutional Equities at Centrum Finance, a man with a deep conviction and deep understanding of markets. And both Sakshi and I hope you found this interview fairly informative as well as exhaustive. Thank you for joining us on Market Masters, and we hope that you will continue watching Business Today television for all your financial news needs. Have a nice day.